tech companies are announcing massive layoffs and the situation is going to get worse for all sectors. In this video we will tell you about some cases of companies that are making massive layoffs and we will analyze the employment situation in the United States for the coming months. Let's start by analyzing one of the industries that has announced the most layoffs, the technology industry. Meta laid off 11,000 Facebook, Instagram and WhatsApp employees worldwide, reducing the number of employees by 13%. This is because the company hired so many people during the pandemic, thinking that e-commerce would explode, but it didn't. In an interview, Mark Zuckerberg, owner and founder of Meta, said that the reasons for the layoffs were because online commerce had returned to pre-pandemic levels. That is, that it was selling less, but also that the recession of the economy and the increased competition for the new amount of social networks like TikTok had caused Meta to have less ad revenue than it had expected. And if we look at the data for online commerce and the economy, Zuckerberg is right in his analysis. On the one hand, in this graph we can see internet sales in the United States from 2012 to 2022, and it can be clearly seen how 2020 and 2021 were years of tremendous growth, which made Mark Zuckerberg optimistic, giving employment to many people. But 2022 is being a bad year and now all those people are redundant in the company and they had to be fired. On the other hand, Zuckerberg's analysis of the recession is also correct. An economic recession is when companies in a country produce fewer products and services because people consume less, and this leads to layoffs due to less production. But when there are more layoffs, there is less consumption because people lose their jobs, so companies produce less and have to make more layoffs, developing a negative cycle. One of the ways to know if an economy is in recession or not is by looking at the gross domestic product, an indicator that represents everything that is produced and consumed in a country in a certain time. And if we look at this graph of the quarterly gross domestic product in the United States, we see that in 2022 the country already had two periods, the second and third quarters, where the economy shrank, which is a clear indication of recession. And these problems in Meta were reflected in its stock market valuation. If we look at the price of Facebook's share, the blue line, compared to the Nasdaq, the orange line, which is an index that calculates the average of the shares of technology companies, we will see how in 2022 Meta fell more than the Nasdaq with 66%. That is, if you had invested $1,000 in Meta at the beginning of the year, now your investment would be worth $444. And even though its financial results continue to be positive since companies continue to have profits in the last quarter, they were of 19.62% for their investors. It is evident that the number of employees they had before the layoffs was much more than they needed for the next few months. But Meta isn't the only company laying people off. A few days ago Twitter, a company that was recently bought by Elon Musk, the billionaire owner of Tesla, also announced layoffs of almost 50% of its total employees worldwide, resulting in almost 3,700 people losing their jobs. When asked about the layoffs, Elon Musk said there was no other option as the company was losing $4 million a day, forcing the company to cut costs. And just as Meta and Twitter have already laid off a significant part of their staff, there are other companies that are also planning to do so. Amazon plans to lay off 10,000 people in the coming weeks, and the reason for these layoffs, like Meta, is over-optimistic as the company is growing at an increasingly low level. This graph shows us the sales growth for a quarter compared to the same quarter of the previous year. For example, Q2 2022 versus Q2 2021. And as we can see, in 2022 growth has slowed down a lot. In fact, Amazon's profit fell sharply in 2022. This chart shows us Amazon's profit by quarter. The last three bars show the result of the first three quarters of 2022, and in two of them the company had losses. And this is consistent with the fact that online sales have fallen since Amazon is an online sales portal. For this reason, like Meta, so far this year Amazon, the blue line, has fallen more than the Nasdaq, the orange line, with a 43.5% devaluation. That is, if you had invested at the beginning of the year, your investment would now be worth almost half. There are other companies in the technology sector, although not in large numbers, are also laying off. For example, Microsoft laid off 1,000 people due to the possibility of an economic downturn. Another example is Netflix, which laid off 150 people after losing 200,000 subscribers, which represents 2% of its workforce. But not all big tech companies are laying people off, though all without exception are bracing for a major recession. Apple, for example, decided to cut budgets, that is, lower the company's costs and freeze hiring, and what is happening in other slightly smaller companies in the technology sector. Unfortunately, they are also taking similar steps and laying off a large part of their person. For example, Robinhood, a company that sells investment-related services through an app, cut 23% of its staff after reducing the operation of its business by 43%. That is, it worked almost half of what it came from operating. In fact, at the end of the second quarter, the company registered 41% fewer losses, but the platform business fell 43.7%. That is, it had fewer losses because it reduced expenses but sold less. On the other hand, the drop in computer sales makes Intel also plan layoffs that could reach 20% of its workforce. This chart shows us how computer chip sales change from month to month what Intel makes the most. The white line shows the variation in Intel sales and is in full decline. And the list goes on and on. Snapchat lays off 20% of its employees and cancels internal projects such as in-app game development. Coinbase, a company that has an online platform through which you can buy and sell cryptocurrencies, laid off 18% of its staff due to the crisis in the cryptocurrency market. This graph shows us the total value of all the cryptocurrencies that exist, and as we can see, it has been falling a lot this year, which makes people sell their cryptocurrencies and walk away from that investment, leaving Coinbase with fewer clients. Another case is that of Lyft, the company that has a travel application similar to Uber, and that laid off 13% of its staff for fear of a recession, but the layoffs do not end there. Layoff.fi is a website that tracks layoffs in technology companies, even small ones, and as we can see on its website, there is a long list of companies laying people off. The pandemic represented a great opportunity for tech companies as lockdowns made people spend a lot more time at home and used many of the services that these companies offer. But those times seem to be behind us, and now all tech companies are suffering declining sales, laying off people and preparing for the worst. And that is being seen in the price of its shares. The Nasdaq, which as we said before represents technology companies on Wall Street, has fallen almost 30% so far this year. But that only represents an average, since there are many companies that had even stronger falls, such as the case of Meta, and even companies that collapsed up to 95%. For example, the share price of Upstart, a company that gives loans online, it fell from $263 a year ago to nearly $20, a 92% drop. If you had invested $1,000 in this loan company last year because people were buying a lot online and you thought it was going to get bigger, now you would have $80 left. Fun, right? There is also the case of Affirm, a company that offers financing in installments for online purchases, whose price fell from almost $105 at the beginning of the year to only $14 today. And all this started when the Federal Reserve began raising interest rates of U.S. Treasury bonds to combat inflation. The Federal Reserve is the central bank of the United States, and like any central bank, it is mainly in charge of two things. The first is to define the interest rate on the United States Treasury bond. The Treasury bond is the instrument that the United States government uses to borrow money from investors in the stock market, and the interest rate is the profit that those investors will obtain for lending money to the government. Throughout 2022, the Federal Reserve has been raising rates, thus giving the investor a higher profit with the aim of lending them more and more money. But how does this rate increase help fight inflation? Inflation is generated when a government prints too much money. And in recent years, that is exactly what has been happening. The United States government has been printing a lot of money, especially during the pandemic, to assist people and companies in need. So if excess money is what generates inflation, to lower it you have to get all that money that is extra in the economy. That is why the Federal Reserve increases rates, so that investors prefer to invest their money in the Federal Reserve thanks to the profitability that it returns instead of investing it in companies or in making businesses grow, and thus the United States government takes money from the economy to lower inflation. But the problem is precisely that since investors stop investing in companies to give the money to the government, that makes companies have less money, and that is why the economy shrinks and enters a recession. And despite the increase in rates, it seems to be working. Since inflation has been falling very slightly, there is still a long way to go to get it completely under control, so the crisis will continue to get worse, and time is a big problem for these companies technological because they need growth to survive. The growth model of these technology companies is simple. spend a lot of money even working at a loss to grow as fast as possible and beat all competitors. This is so because many of the technologies they use are easy to copy. So a company needs to grow very quickly before the technology is copied and many competitors emerge. So they need many investors who are willing to give them money all the time to bear the losses and have the rapid growth they expect. But with the Federal Reserve raising rates and taking investors away, companies are running out of money to sustain growth, and so people are being laid off. And since rates are going to continue to rise, then it is most likely that these companies have fewer and fewer investors and they will continue to shrink. Now that we have seen what is happening with technology companies, what could happen in the future, and what about the rest of the labor market? If we analyze the word layoffs in relation to the number of searches on Google, we can see that more and more companies are talking about it on the internet, and it is becoming a growing concern among the population of the United States. That tells us that many people are commenting that they were fired, or that they are afraid of being fired, or that they are investigating layoffs, but this is not the only indicator. Applications for unemployment benefits from the United States Department of Labor had been going down until April 2022 and started going up from there, and coincides with the beginning of internet searches. This is telling us that the layoffs go beyond just the tech industry. We are going to see more and more layoffs in different industries in the United States, and to do the analysis we are going to use various indicators that describe the labor market. Some people think that today in the United States there are still many job offers, and if we look at this graph that shows us the number of job offers that are published per month, we can see that beyond small changes the job offer has remained stable, but the problem is that this indicator is not completely complete and is not useful for predicting the future. So we are going to see other indicators that can help us to know what can happen in the next 3 to 6 months if the Federal Reserve continues raising rates and generating more recession. There are many ways to measure what is happening with employment, so we will look at various indicators, but we will start with the most popular. On the first Friday of each month, the United States Department of Labor releases the Labor Situation Report. This is a report that basically talks about employment in the United States, and even though it provides a lot of information, the data that everyone looks at is the number of new jobs that are created. This differs from the indicator we saw earlier related to job openings, since if a company hires a person to replace a person who left, they will have posted a job opening but are not actually creating a new one. That means the job openings indicator will always show a higher number because it considers both new jobs and job replacements that already exist. If we look at the graph of new jobs for the year 2022, we can see that even though new jobs are created every month, the trend is that fewer and fewer are created. And to calculate this indicator, the Department of Labor carries out 2 surveys, one that is carried out in companies and another that is carried out in homes, both in relation to employment. The first and most used by newspapers and news channels is the one carried out in companies. This is a survey that is done mainly to large companies where they are asked how many people they fired and how many people they hired. So if we subtract those fired from those hired, we have the net number of new jobs that were created. This can be very inaccurate because it only takes a few large companies, but it is the most popular and widely used measure of whether employment is going up or down. The business survey shows that the U.S. economy has been creating between 200,000 and 500,000 jobs in recent months, although it also shows that the number of new jobs is dwindling. On the other hand, the household survey does not show the number of jobs from the perspective of the company but from the perspective of the workers, that is, how many people are employed. The difference between the 2 surveys is how it is counted when a person has more than one job. The most popular company survey counts all jobs, so if a person has 3 jobs at 3 different companies, that is counted 3 times. On the other hand, the household survey counts each person who is working, not each job, so a person who has 3 jobs only counts once. And if we look at the household surveys, the result has been much worse than the business survey, even showing job losses in some months of this year. So what we are seeing is that both surveys are showing that job creation is falling, and the fact that the household survey result is considerably worse than the business survey result means that many people in the US are forced to have more than one job to survive. So far we have seen some indicators that are showing us that employment in the United States seems to be falling. Even if we look at the unemployment rate, which shows the percentage of people who are without work, we can see that in recent months it is starting to grow very slowly, especially the months of August and October of this year. The company EPB Research, which is dedicated to creating indicators to measure the economy, created its own employment indicator that allows the trend for the coming months to be seen more clearly. This indicator was made by combining several of the other employment indicators, and that makes it more complete when it comes to measuring the level of employment. This index shows us at what percentage rate the level of employment has been growing or decreasing. The black line represents the change from month to month and the green line shows the historical average, and until 2021 employment had been growing well above the average, which means that the level of employment was very good compared to other years. But since the beginning from 2022 growth was less and less, even to the point of being very close to the historical average. And if it continues to fall, it could even end up being negative, which means that not only are jobs not being created, but jobs are being destroyed, which means that companies are laying people off, but not replacing them. All the indicators seem to show that employment in the United States is going to continue to fall and that more and more people in the United States are going to lose their jobs. So the question is, what indicator could confirm if the trend will continue in this way? In the future, one way to measure this is through the hours worked. The hours worked are a good indicator to anticipate what could happen with employment because most companies, before laying off their staff, choose to cut hours. Laying off people when there is a recession is the last resort since many times valuable people end up being fired and with a lot of investment in their training for that position just because of a cost issue, which is why many companies decide first to lower the hours, thus lowering the cost and leave layoffs as a last option. If we look at the hours worked per week by an average American, we can see that this number has been falling almost constantly throughout 2022 and that while in 2021 people worked on average more than 34.8 hours per week, in October 2022 the average it was 34.5, and even though this variation seems small, it is indicating that companies are reducing hours and that if this trend continues they could turn into layoffs. This means that in the next 3 to 6 months there is a strong possibility that the U.S. economy will start to see job losses in all sectors beyond the technology industry. The increase in layoffs would be the confirmation of the recession since a recession will always bring job losses. This is because in a recession the entire economy shrinks, including people's income, consumption, production and employment. But the peak unemployment is usually seen some time after the crisis begins. In this graph we can see the gross domestic product of the United States in blue and the unemployment rate in orange, that is, the percentage of people without work, and there it can be seen that the highest peaks came some time after the crisis began. In the 2000 crisis, maximum unemployment was reached in July 2003, 3 years after the gross domestic product began to stagnate, showing the first signs of recession. And in the 2008 crisis, the peak of unemployment was seen at October 2009 when the gross domestic product had begun to slow down in mid-2008 and the crisis would finally break out in September. That is, in economic recession crises, you first see a drop in gross domestic product and some time later you see the worst of the crisis when maximum unemployment is reached. So, if today we are seeing that the gross domestic product is beginning to fall, that means that we are at the beginning of the crisis. So today more than ever it will be important that you take care of your work, that you work well and that you be good at what you do so that when the time comes for layoffs your name will not be on the list.